Good morning and welcome to the Union Pacific webinar. My name is William Eatwell. The agenda for this webinar will be as follows. Recommendation, nature of business, financial review, divisions, company guidance, and lastly, portfolio guidance. Moving on to the recommendation. On a relative valuation basis, the share offers value, trading at a forward PE of 18. On an absolute valuation basis, it's fully valued, in line with the long-term historic average. Improved earnings remain dependent on its ability to offset rail inflation costs and grow volumes. Volume growth on a quarter-to-quarter basis is likely to remain volatile, given the cyclical nature of transported products. Volume growth is an integral determinant of earnings growth for Union Pacific, given its large fixed cost base. Domestic intermodal growth could see an uptick owing to the implementation of electronic logging devices, ELDs for short, as part of a federal mandate to monitor truck drivers' hours. Increasing prices as well as productivity gains, which could enable the company to realize its operating ratio of plus minus 60% by 2019. The company remains well positioned for an uptick in plastics, which will be the result of cheap feedstock from the Gulf. Positive train control assets could enable the group to make productivity gains as well as safety enhancements, but is likely to prove a headwind for earnings in the short term. Share repurchase activity is expected to continue and should support the share price. Moving on to the nature of business, Union Pacific, listed on the New York Stock Exchange, is one of America's leading transportation companies. Its principal operating company, Union Pacific Railroad, is North America's premier railroad franchise, covering 23 states across the western two-thirds of the United States. Moving on to the financial review. Operating revenue increased 8% to $10.4 billion. Quarter 2 showed a 10% increase in operating revenue to $5.3 billion. This consisted of an 11% increase in freight revenue to $4.9 billion and a 59% increase in fuel surcharges to $234 million. Quarter 2 freight revenue benefited from a 5% increase in volume as carload volume increased in 4 of the 6 product groups, with a 17% increase in coal and 15% increase in industrial products, which was offset by automotive, which decreased 1%, and chemicals, which decreased 2%. Positive core pricing in Quarter 2 improved 1.5%, although with coal and intermodal businesses experiencing competitive pricing pressures. Excluding the impact of coal and intermodal businesses, Quarter 2 pricing increased in the other business lines in the 2 to 3% range. Quarter 2 business mix impact on freight revenue was a positive 1%, where grain car loadings and frac sand shipments were key drivers. Operating expenses increased 5% to $6.6 billion. Quarter 2 operating expenses increased 4% to $3.2 billion, largely on the back of a 3% increase in compensation and benefits to $1.2 billion due to higher wage and benefits inflation. Quarter 2 purchase services and materials increased 5% to $597 million due to higher volume-related costs, which were slightly offset by joint facility expenses. Quarter 2 fuel costs came in 25% higher to $434 million, which was made up of a 10% increase in gross ton miles driven, even though the consumption rate improved 3%, as well as a 17% increase in the average fuel price to $1.69 per gallon. Quarter 2 equipment and other rents decreased 5% to $273 million due to lower freight car and locomotive lease expenses, and mix of traffic contributed positively. Quarter 2 other expenses reduced by 10% to $219 million, with lower personal injury, environmental, and other costs. Operating profit before depreciation was 11% higher to $4.8 billion. Depreciation increased 4% to $1 billion. Quarter 2 depreciation increased 4% to $525 million due to a higher depreciable asset base, which includes the positive train control assets that have been integrated to date. Operating profit was 13% stronger at $3.8 billion. Quarter 2 operating profit was 21% higher to $2 billion. Quarter 2 operating ratio, which is a key metric used in the rail industry, saw a 3.4% improvement to 61.8%. Net interest expense was up 3% to $357 million. due to the additional debt issuance. Profit after tax was 14% higher at $2.2 billion. Quarter 2 profit after tax increased 19% to $1.2 billion. Diluted earnings per share increased 19% to 276 cents. The outstanding share balances declined 4%, whereby 15.3 million shares have been repurchased. The 2017 average price per share repurchased was $107.85. Quarter 2 earnings per share increased 24% to 145 cents, beating Bloomberg consensus of 139 cents. Quarter 2 earnings per share were supported by pricing, where average revenue per car was up 6%, volume, which was up 5%, productivity gains, and share repurchases. Dividend declared was up 10% to 121 cents. Quarter 2 dividend declared was up 10% to 60.5 cents. Moving on to divisions. As one can see in the segmental overview, the business mix of Union Pacific is spread between 6 largely commoditized but diverse product groups. The Agricultural Products Division contributed 18% to revenue. Revenue is up 7% to $1.8 billion, aided by a 5% increase in volume and 2% increase in average revenue per car. Quarter 2 showed a 7% increase in revenue to $907 million on the back of a 3% increase in volume and a 3% increase in average revenue per car. Quarter 2 grain car loads were up 11% due to strength in wheat exports, mainly to Mexico and the Gulf. Quarter 2 grain products were down 3% due to a decline in soybean oil shipments due to soft biodiesel production. This was offset by strong export demand to China and Brazil for ethanol. Quarter 2 strong summer demand from the beverage and brewers markets, as well as sustained strength from sugar shipments, increased the food and refrigerated volumes by 3%. Going forward, high global production of wheat and seed grains and a lower quality domestic harvest is expected to create headwinds in Union Pacific's export markets. The Automotive Division contributed 10% to revenue. Revenue was up 2% to $1 billion, where volume decreased 2%, but average revenue per car increased 4%. Quarter 2 showed revenue increasing 5% to $513 million due to a 6% increase in average revenue per car, while volumes declined 1%. Quarter 2 softer vehicle sales led to finished vehicle products decreasing 4%. However, this was slightly offset by an increase in Mexico production growth and new West Coast import traffic. Quarter 2 parts saw a 2% increase in volume due to growth in light truck and over-the-road conversion demand. Going forward, management remains cautious with respect to auto sales due to rising interest rates, higher inventories, and the current sales trend. The Chemicals Division contributed 17% to revenue. Revenue was up 2% to $1.8 billion, where volume declined 3%, but average revenue per car increased 6%. Quarter 2 revenue saw a 4% decrease in revenue to $898 million, supported by a 6% increase in average revenue per car, while volumes decreased 2%. Quarter 2 volumes were affected by a 25% decrease in petroleum and LPG shipments due to lower crude oil prices and available pipeline capacity. However, Quarter 2 plastic car loads were up 6%, which saw an increase in PE and PVC shipments. In addition, Quarter 2 fertilizer shipments yielded a 13% improvement, mainly due to potash exports. Going forward, chemicals are expected to remain stable, with growth anticipated in plastics. The Coal Division contributed 12% to revenue. Revenue was up 25% to $1.3 billion, aided by a 17% increase in volume and a 7% increase in average revenue per car. Quarter 2 showed a 25% increase in revenue to $619 million, where volume increased 17% and average revenue per car increased 7%. Quarter 2 volume was supported by higher natural gas prices and strong export demand to Asia, as well as shipments out of Powder River Basin, which increased 17%, Colorado, which increased 4%, and Utah, which increased 14%. Quarter 2 stockpiles were down and are below their 5-year average. Going forward, management expects absolute volumes to be sustained sequentially if export demand and high natural gas prices remain. Moving on to the Industrial Products Division, this contributed 19% to revenue. Revenue was up 6% to $1.9 billion, supported by an 8% increase in volume and 8% increase in average revenue per car. Quarter 2 indicated a 24% increase in revenue to $1 billion, where volumes increased 15% and average revenue per car increased 8%. Quarter 2 volumes were supported by a 73% increase in mineral volumes and a 128% increase in sand shipments as a result of higher well completion and increased proppant intensity per well. In addition, specialized markets quarter 2 volume increased 20% due to a 29% increase in waste shipments as a result of the West Coast remediation projects. Going forward, management expects frac sand volumes to remain healthy, although new in-basin brown sand mines may not see the same upside. Furthermore, management expects wind and military shipments growth being offset by cement and roofing, owing to changing market dynamics. The intermodal division contributed 18% to revenue. Revenue was up 3% to $1.8 billion, where volumes increased marginally by 1% and average revenue per car increased 2%. Quarter 2 saw a 3% increase in revenue to $939 million, where volumes increased 2% and average revenue per car increased 1%. Quarter 2 volume was increased on the back of higher domestic volume growth of 2%, which was driven by an improved truckload market demand and higher parcel growth, and a 2% higher international volume due to inventory restocking and westbound shipments. Going forward, management expects the domestic market to provide opportunities owing to additional over-the-road conversions. The other product category contributed 7% to revenue. Revenue was up 2% to $682 million. Moving on to company guidance. Management remains cautious regarding the continuing competitive price pressures in the coal and intermodal businesses. Management is seeing truck prices beginning to firm and is expected to continue due to electronic logging devices coming online. Volume should be stronger in the second half of the year. Targeted operating ratio over the longer term is expected to be plus minus 60% by 2019, with a goal of attaining 55% beyond 2019. Management expects to continue the momentum of volume, productivity initiatives, and pricing to attain this goal. Full year guidance. Labor inflation is expected to be 5%, which will be partially offset by productivity gains and the smaller workforce. Depreciation expenses are expected to increase to around 4 to 5%, whereby approximately $130 million will be in respect of the positive train control assets. Management is confident in attaining the $350 million to $450 million productivity goal. Growth in car loading is expected to be up in the low to single-digit range. Moving on to portfolio guidance. Union Pacific is a solid company with best-in-class rail operation. It has an extensive physical presence. It boasts attractive operating margins. It has strong cash generation, high ROE. Its business mix is well diversified, and we recommend the share to longer-term investors given the volatility in earnings on a quarter-to-quarter basis. Recommended exposure is up to 7%. If you'd like to place a trade, please contact our trading desk. In addition, if you have any questions, we'll be happy to answer via email correspondence. That brings us to the end of the webinar. Thank you for attending.